Hey everyone, gonna wait for a few to get on before I start tonight. Check my phone here, make sure we are live. Yay, we're live, awesome. Are live. All right, so I know we're good. All right, so we are going to get started. Just before we get started, welcome everybody. I know I changed the time up on you a little bit today, and I did that because I got some feedback from some of you that 2 o'clock just wasn't working. You're still at work at 2, and that 8 o'clock would be a better time for you guys. So I hope this works. If you are joining me live, if you would just tag yourself below in the comments, give me a thumbs up, or give me an emoji of how your week has started. My Monday has been a little crazy, but productive, so that's a good thing. So before we get started, I want to just give you a quick introduction in case you are new with me on Calculated Profits. My name is Stephanie Manley, and I have been in the tax and accounting industry practically my whole life. So my mother was an accountant. I grew up in the family business, and then about 10 years ago, I took over that family business, rebranded, and about 4 months ago, I actually took my firm virtual. And actually rebranded at the same time. And so with that, I'm able to come live to you every Monday, and it should be 8 o'clock now. If you'll actually just tell me if 8 o'clock works better in the comments, that would help me a lot. But that way, I'm here to help small business entrepreneurs pay less taxes, number one, and enjoy their business. So that is my main thing. You guys went into business for yourself to enjoy yourself, not work harder. So just join me as we go through this together. Also, let me see, I'm looking at my notes here. So I'm a big note taker, guys. I'm going to refer back to this a lot. If you are new to me as well, or if you have not already caught my entrepreneurial journey video, I posted a video a few weeks back about how I came to be where I am now. So if you'll go watch that video, it was a very emotional video for me, and you can see that throughout the video as well. So I'm very, very passionate about coming to you guys and giving you advice and helping you make the most of your business, because I believe that our country is what it is today because of small businesses. So that's where I'm here for. And also right now, I'm going to put this up here so you can see it. But I have a freebie for you guys. It's going to be free here for a little bit longer. We call it the Calculated Tax Planner. So if QuickBooks is just not for you, and you don't want to pay for QuickBooks, or maybe it's just a little too complex, I have actually put together a very easy to use spreadsheet for you to get your books in order for tax season. Tax season is coming up. We've got 7 weeks, I do believe it is. So you can download the free tax planner by going to that website there. Just put in your name and your email, and I'm going to send you over that freebie as well. So today's live, what is today's live about? And I'm really, really, really excited about this live today because my favorite thing to do in my industry is to strategize on your taxes. So doing the books is fun, don't get me wrong. Doing your taxes is fun as well, but it's the in-between part that I enjoy the most, and that is my secret sauce today. So drum roll, please, what the secret is of paying less taxes, and that is tax planning. Tax planning. It's a secret. Not really a secret, but a lot of people don't talk about it because they don't know to do that. So for most people, taxes are get all your books together, print out that profit and loss and balance sheet, give it to your accountant, your tax preparer, and then they prepare the taxes, okay? Well, doing that is not saving you any money, okay? That's just the nuts and bolts of taxes, okay? We need to take it to another level so that you can actually save. So with that, I want to say that tax planning is not the same as tax preparation. They're completely different. Okay, and I'm going to tell you a couple of things and how that is. And again, I'm going to refer back to my notes, so sorry for not looking at you all the time. So tax preparation is simply the filing of your tax return and taking the basic deductions and credits. That's what tax preparation is. Now, tax planning is actually using the tax code to your greatest advantage. Okay. Now, some people say to me, oh, I don't want to do anything that's going to get me in trouble. I'm really scared of the tax man. And I tell you this, there's two things here. You have tax avoidance and you have tax evasion. Okay. Tax avoidance is tax planning. That's lessening your tax liability based on the tax code. They wrote it that way. We have to take advantage of it. Okay. Tax evasion is when you do things deliberately to underpay your taxes. So tax planning is not tax evasion. Okay, so I just want to go ahead and get that out there. All right. So moving on a little bit, a few things about planning, and then we're going to get into a few planning tips that I like. So planning one requires a lot of understanding of tax. It requires you to know the tax code. And by the way, did you know that there's like 4,000 pages of tax code? Little bitty writing, tax code. So you gotta have, gotta know the tax code. You have to know how that affects your tax return, and you have to know business accounting. So you have to know all of those things, which actually brings me to a question that I'm asked on a regular basis. So what is the difference in a bookkeeper, an accountant or CPA, tax preparer, and a virtual CFO strategist, which that is what I do. So I'm just going to tell you the basic differences of the three. And there's no right or wrong. It doesn't mean that you need one or the other. But a bookkeeper typically knows the ins and outs of, say, your check register. They know what's coming in and out, and they categorize those expenses. Okay. A accountant, tax preparer / CPA, they know a lot about tax code. A lot of them also are bookkeepers, so that's a plus. And then I also want to throw out here to you guys that I get asked, do I have to have a CPA or can they just be an accountant? What do I have to do? What are the requirements? You need to know that your tax preparer does not have to be a CPA. Okay. I will say just from experience that there's some bad CPAs and good CPAs. There's bad tax preparers and they're good preparers. So do your due diligence. Don't just look at the 3 letters behind their name. Do your due diligence to make sure that the person knows their stuff, and also make sure that you and that person can get along and converse and you're on the same level. So that means a lot as well. And then you have the virtual CFO or strategist. So this person actually takes the work from the bookkeeper and the work from the accountant, and they kind of work together and create that strategy. So a CFO is going to do a lot more planning and strategizing for your business. So that's the difference there. I look at this person, whether it be bookkeeper, accountant, or your virtual CFO, as like your doctor. Who would you want your doctor to be? You want to be comfortable with them. You want them to be able to answer your questions, and that they know what their stuff. Because going to a doctor is very similar. It's very private, just like talking about your business finances. Okay. Also, planning is a long-term event. This is not something that you're going to sit down with your accountant or your virtual CFO for one time a year and do planning. That's not how planning works. That's how tax preparation works, but not planning. So it's an ongoing event, looking at the future and seeing what things you can change in your business to benefit you in the long run. Also, remember, planning is a very tedious job and it's ongoing. So as we talk about these tips in a little bit, the way I like to do with my clients when I do analysis for them is I like to give them options. So, I may say your tax savings if you go with option 1 through 3 is X, but if you only choose one, it's this. So that's part of the strategy. And by doing all those different analysis is doing a return for all those different types of strategies as it goes. So it's not an easy task. It's not a quick task, but it's something that you do on a regular basis and you do it over a period of time. There is a saying here, I'm going to click there, that if you fail to plan, you are planning to fail. And I believe that was Benjamin Franklin that said that. And it's true, guys. You have to plan ahead. You can't just do things on a whim, make business decisions on a whim, and feel that it's going to affect your business in a great way. Okay, so any questions so far? I'm going to check over here the comments. Nope, I don't see any questions so far. Give me a thumbs up if you're still live with me. That would be great. And I told you guys before you went live on my little blurb to get your favorite beverage of choice. So I did have me some wine here tonight as we go through this. It's 8 o'clock, right? So let's get into my 5 favorite planning tips. And I'm going to go into a little bit of detail with these. But then if you have any questions, always, contact me and I'll be glad to go around with you. So the very first and the easiest planning tip that I have for you in your small business is to time your income and expenses. Well, what does that mean? Well, it's getting close to the end of the year. Like I said, we've got about 7 weeks left. So timing your income means that maybe you don't invoice your clients in the latter part of December until January. Because if your accounting is on a cash basis, you count the income as it's received. So say you have a big project, the client owes you $5,000 and you invoice them on December 31st and they pay you on December 31st, then you're going to pay taxes on those $5,000 in 2020. But if you were to wait and invoice them, or even for them to pay you in 2021, you do not pay the taxes on that money until 2021. Okay, so that is how you time your income. Now, timing your expenses would mean to go ahead and pay your vendors, pay your utilities, all those things. Go ahead and get those paid before the end of the year. Okay, so all your checks have to be written. They need to be mailed out, credit cards paid, what have you, by December the 31st to count for the 2020 tax year. So again, time your income and time your expenses. Okay, accelerate expenses, defer income. That only works, remember, on a cash method basis. Okay, and most of you are. All right, your second thing is going to be to make the most of depreciation. So what is depreciation, you might ask? Well, that is the expense write-off of any assets that you purchase in your business. So say you are a consultant and you had to buy a new laptop. That laptop would be depreciated over a lifespan. But with the Tax Cut and Jobs Act of 2017 that was expanded, you are allowed 100% depreciation on most assets up to $1 million. Okay, so let me give you an example of that as well. Say I am a plumbing company and it's December and I need a new truck for my company, a work truck. Okay, so I go and I buy me a new work truck, and let's just say it's $50,000. Okay, and I'm going to finance that work truck, which means I'm going to pay payments on it over a period of time. Well, with this particular Tax and Jobs Act, you can write off $50,000 of the truck against your income in 2020, even though you're making payments on it. Okay, so I hope that helps and that makes sense to you. And then as you make those payments through the period that it's financed, you write off the interest. Okay, so you had to have purchased it and it needs to be in service before the end of the year. And those are, I mean, you can buy printers, computers, furniture, equipment, those types of things is what I'm referring to here. Okay, so allows up to 100% depreciation on assets up to $1 million in the year that it is acquired. So that would help tremendously. Say your profit is $50,000 and you need that new work truck. Well, that work truck being depreciated at 100% just wipes out all of your income. Okay. Now, I will go ahead and just throw out here that I do not advise that you go and purchase things just to wipe out your tax liability. That's silly, guys. It's not dollar for dollar. So if you need it, that's great, but make wise business decisions. Okay, so for number 3, I'm going to get in here, is the qualified business income deduction, or as we call it in the accounting world, the QBI. This was also part of the same act that I was discussing with the depreciation, but this allows some business structures to deduct 20% of their net business income as a deduction. Okay, and as a side note, I said some business structures. So it really depends on how you're set up, LLC, S Corp, C Corp. Not all of them are able to actually get this deduction. Okay, all right, moving along, number 4. And this one gets missed a lot, especially when you're self-employed. So, when you're an employee and you get the information every year for you to decide, hey, I want to participate in your 401k retirement plan, it's real easy to check the box and say, yeah, withhold 3%. Okay. But when you're self-employed, it really seems to me that this gets put on the back burner. So you work your tails off your entire life being self-employed. You get to the end of the road and you're ready to retire and you look back and go, oh crap, I don't have any money, nothing set aside. And this happens a lot with self-employed people. So let's talk a little bit about funding your retirement accounts. And you have several options being self-employed. And I will advise here to see a financial advisor on which one works best for you with this going. So work with your financial advisor, work with your accountant as well. And between the two of them, they can come up with the best solution between making you more money in retirement and saving you money, because there is a middle road there and you need to work together. So the first is going to be a SEP IRA. Those are only for self-employed individuals. And you can contribute to that up to 20% of your self-employment earnings. Okay, so that's number 1. The second is a self-employed 401k plan. Okay, so that one you're going to have to be on payroll with. You can actually contribute up to $57,000 a year to that plan between the employer side and the employee side. So there is a cap on that one, $57,000. And then you have an IRA, and there's 2 types of IRA, and there's benefits to both. An IRA also has a max of $6,000 for 2020, and if you're 70 or older, you can contribute $7,000. So a traditional IRA, I get asked a lot, well, what's the difference? Well, in a nutshell, a traditional IRA saves you money now on your taxes. Okay, so you get the tax benefit of it now, but you're going to pay taxes on it later when you go to retirement. Okay, that's traditional. A Roth IRA is different. A Roth IRA, you are not going to get the benefits now, but you're going to get the benefits later. Doing a bunch of analysis with this and actually working with a financial advisor a few years ago, I strongly recommend a Roth IRA. That's just my personal opinion. Again, that's not tax advice for you specifically. Talk to a financial advisor. But a Roth has, it seems, more benefits in the long run. And I'm a long-term planner, not a short-term planner. So those are the things. Again, just to rehash, we have a SEP IRA, that's SEP, SEP. You have a self-employed 401k, and then you have an IRA, which is Roth or traditional, okay? But no matter which one you choose, just please put some money up for retirement, guys. It's very, very important. Don't work so much and spend all your profits. Put some of them away so that when you retire, you do have a little nest egg, okay? So any questions so far? I'm going to check my comments. I don't think there may be, and I just don't see them. Remember, guys, if I'm streaming StreamYard, so I got to make sure you tag up there at the top for me to be able to talk with you or see your comments. Awesome. And if you're watching this as a replay, remember, please do hashtag replay for me. All right, so my fifth tip for tax planning is to leverage health savings accounts, so HSAs. Again, this is one of those things that as an employee is easier for you. You put little chunks every paycheck, right? HSAs and the funding the retirement is a little different when you're self-employed because there's a lot bigger chunks coming out. HSA, what is an HSA? That is putting money aside for qualified health expenses. So if you are part of a high deductible health insurance plan, so if you got your health insurance off the marketplace, you're probably part of a high deductible healthcare plan, then you can contribute to an HSA. Those contributions are tax deductible. The contributions grow, and those that growth is tax-free. And when you when you withdraw the money for qualified medical expenses, those withdrawals are also tax-free. Okay, and then the contributions on those, I'm looking at that for 2020 was $3,550 for just for you. But if you have a family, it's $7,100. So you can put $7,100 aside for medical. So what is that? Co-pays, prescriptions, your deductible. Those are the things that money can go towards, and it's tax-free. Okay. All right. So I'm going to move along here. All right. So those are my top 5. And again, I'm going to rehash them really quick for you. So time your income and your expenses, make the most of depreciation, your qualified income deduction, fund those retirement accounts, and leverage health savings accounts. Okay. And then I have 3 more that I just kind of want to plug in here real quick. And I'm not going to go into a bit of detail, but these are part of planning, and I wanted to throw these out to you. The first one is going to be to know your entity type, know the advantages and the disadvantages of those entities. Okay. So there comes a time when there is an advantage from moving to it from an LLC, taxed as a sole prop, to moving to an LLC, taxed as an S corp. There comes a time there's that sweet spot. Okay. If you do it too soon, you're paying too much tax. If you do it too late, you're paying too much tax. And that's all part of planning, guys. Okay. So that's number 1. The second thing, which people go, really, you can do that? Well, I do this. And that's add your kids to payroll. Okay. Of course, there's some rules and regs to this. The kids have to work. You really do some work, guys, not just sit around and play video games. They really have to do some work in your business, and and their wages have to be like normal wages. You can't pay him $100 to take out the trash. Okay. Things like that. Okay. But there's no age limit on that. All right. So you may have a 10-year-old who's on payroll. You may have a 15-year-old that's on payroll. It's okay. It's completely legit. Remember, we talked about that earlier. Okay. So add your kids to payroll. And the final thing that I want to discuss is the home office deduction. And I discuss that mostly because most of us are home now. We're working from home. We have expenses from home that we typically didn't have before. And so take advantage of the home office deduction. So with all of that being said, please be proactive instead of reactive. Once your taxes are filed, once 12/31 at midnight or 11:59 happens this year, you can't make any changes, guys. It's done. The books are closed. You're finished. So you have 7 weeks. If you haven't already done so, and if you didn't, I don't want to know. I'm kidding. Get your books in order. Know what your profit is. Know the items that maybe you can take advantage of before it is too late. Okay, so please be proactive in your business instead of reactive. If you have not already got your books in order and you still need to do that, remember there's the link right there for you guys to download the Calculated Tax Planner. Remember, it's a freebie, so go ahead and download it now before it's no longer free. And then talk to your tax preparer, talk to your virtual CFO, your strategist. Talk to them, guys, and get a plan in order so that you're not paying Uncle Sam any more than what he deserves. Okay, I'm all about paying your taxes, but do it the right way. Okay, plan, strategize, do it the right way. Last, before I leave you, if you haven't already, go and join the Thriving Entrepreneur Squad, because there's so many more tips on that particular site, tax, business tips, all different things. So it's a collaboration of all of, like-minded entrepreneurs talking together and trying to strategize together, guys. We're all in this together. We're not competitors. We are in this together, trying to do the best that we can do as a small business owner. So join the Thriving Entrepreneur Squad. And I hope this video helps you a lot. Kind of get your gears a-turning a little bit and get you ready to start tax planning for the next 7 weeks. Thanks so much again for joining me. If you're watching me again as a replay, don't forget the hashtag replay. If you have any questions, don't hesitate to comment below or send me a private message, and I'll see you guys again next Monday night. Thanks so much.